today.
Okay, Rudy here, 27th of December. Hope you had a good Christmas. Welcome to the weekly update of the best 10-year diversified growth ETF for the next 10 years. Although it hadn't been for the last 10. It is now due to this thing called a commodity cycle, shown here since the 1800s. We have the ups and the downs, and here we are here. And we have a live version of this bottom here, because we don't have going back to the 1800s. Now, one of the reasons we have cycles is due to commodity pricing. Where prices are low, companies don't develop mines, demand stays flat or grows, causing a supply shortfall, which leads to rising prices. And it takes about 10 or 15 years to build a mine from scratch, just to increase supply. Now, demand for certain commodities is increasing due to the electrical infrastructure boom we are entering. So things like copper, lithium, get the chart going there, breaking out, and also the fuel required to run the infrastructure, like uranium, natural gas, and I should say for the infrastructure boom, silver required for solar panels. Looking pretty bullish there. We've also entered a hard money boom as central banks around the world diversify away from US bonds into this guy here, gold, making new time highs. Now, you can choose to stay invested in some global world index diversified ETF, like your VAS, VGS, your IVV combination, which professional advisors will tell you to do, and make you 8 to 10% per annum. Now, I used to be one of them, and it's interesting, this article here, Van Eck and Global X go head to head to build the ultimate portfolio. So what are they saying? Well, what you'd expect. Both basically say the same. So, you know, your 40% international, your 20% VAS, a little bit of emerging, 20% bonds, 5% gold, and a bit of infrastructure. And the other mob, gold 7 and commodities 2. So even the ETF providers don't know what they have in their toolkit. Or you can decide to invest in this ETF and make excess returns over the next 10 years. Now, we'll go through where you should have been invested in the last 10 years and why this ETF is best going forward. So first of all, what is it? So essentially it's the MVR ETF, made up of the top 31 Australian mining companies. So BHP, Woodside. It's pretty equally weighted, 7-7, and we go down as we go through the list. It gets a lower weighting, but it's the 31 top miners on the ASX. Is also referred to as the tank. And we'll get into that philosophy as we go through. And he became the tank 4th of August, and he's been up 25%, which isn't too bad, and I expect that to go on. Now, if you have a look at where you should have been, like in terms of your VAS VGS combo. So I use ratios, VGS over VAS. So for the last 10 years, you shouldn't have been invested in VAS at all. And you should have been in VGS, and you'd have an extra 60% under your belt But that's what people do. But then there's the NASDAQ. So NASDAQ over VGS. So technology, you would have had an extra 95% over your VGS in your kitty. So I think you get the picture there that having anything in VAS the last 10 years has been a downfall. But that's what people tell you to do. Now, if you're in America, this is the world ex-US. So this is basically, so Australia would be in this, would have our little 2% allocation. So if you're in America, you still, again, wanted to be invested in the NASDAQ and not outside your country. And you would have made an additional 340%. And that's because we know technology has been where you want to be. So what I'm trying to do is say resources is where you want to be for the next 10 years. So you don't just stick in some boring global diversified market index. So we'll go through some things just to show you why now is the time. It hasn't always been the time, as I said. MVR, the tank, hasn't been where you want to be, but that's what cycles are about. Being invested in some cycle that's going down, you may as well invest in something that's going up. Okay, so MVR over VAS. So if you had made the switch on the 4th of August, you'd have an extra 25% in your kitty. And we don't have a lot of history here. It runs out at 2014. So I'm just going to show you, I use this XMJ, the material index, as a proxy for MVR. And just to prove to you that, like it is. So that's MVR and that's XMJ. So it just gives us a bit of history to play with. So if we look at XMJ over the ASX 300, so this is what I reckon we're entering. We're entering into this period of outperformance of the materials over the ASX 300. You can see we've done it before, and we're now starting a new pattern with a target of outperformance up there. Now the NASDAQs, so this is where you have wanted to be, invested 100%, and you'd be a lot better off. So how does the tank or XMJ go over the NDX? Okay, so you can see, well, back here, you wanted to be in the materials index, and then in 2008, you wanted to be in the NASDAQ. You didn't want to have anything to do with MVR. But you can see now, we're starting to make headways here. And the idea is to get into a boom when it's early, not when it's late. That's why I started the channel. So that was the stiffest competition. So you can see here, MVR over IVV. I'll just go down to a lower time frame. So you see been outperforming 20% MVR over IVV. MVR over VGS up 20%. This best of the best ETF global from Macquarie. MVR's up 18%. VDGR. This is your growth Australian super growth option, because a number of people have in Australian super and Host Plus. You can build your own. You can't invest in the tank, but you can build your own resource portfolio from ASX 300, which a number of subscribers have done. If you had made the switch on the 4th of August, you'd have an extra 25% in your super fund. So it's quite significant, isn't it? All right, so then we got MVR over Qual. So if you had made the switch, you'd have an extra 20%. VDHG, same as DHHF, you'd have an extra 22%. However, we have Ninja ETFs too. So the tank's your core, but you surround him with the ninjas according to your risk appetite and expected. If you want higher growth, you go for ninjas. So one of my favourite ninjas is the silver ETF, ETP Mag. So if we benchmark MVR over ETP Mag, well, ETP Mag's outperform 30%. If you had switched from the NASDAQ to ETP Mag on the 4th of August, you'd be up. You'd have an extra 60% in your kitty. Okay. All right. So that's the proof in the pudding, the benchmarking. So now we'll look at the underlying holdings. In the order of their weightings. So the first one is BHP, who's a miner of iron ore. So this is the iron ore chart. Not expecting gangbuster returns, but just stable, which is all he needs, because he's got the copper price, which is making all-time highs. So that's going to flow through to his revenue. So BHP, so it's just looking wonderful, lovely declining wedge, breaking out, about to make all-time highs. Then we got Woodside. So Woodside have got their natural gas, which is now forming a bottom, and they've got oil. Okay, so I'm not going to make a prediction on the price of oil. I know there's bull and bear cases, just following the charts, which is setting up long term a bullish pattern. You can see we've got a big up flag pole and a bit of a declining wedge here. So if it does break, it will be very bullish. So in the meantime, we've got a quadruple bottom there. So we'll see if this bottom holds on the next test down. But anyway, so Woodside, so they're oil and gas. So they were a buy last week. I think that's the bottom for Woodside. 7% div. Well, that's the other thing with the MVR ETF. A lot of these resource companies pay nice divvies. Okay, so then we got Northern Star. So gold breaking out all-time highs. So obviously that's going to be very positive for Northern Star. I'd say this week will be the week that he makes his next leg up. And we've got Fortescue, so they're pure iron ore miner. I think they're low cost. So as the iron ore, so they pay a nice div, 5.5%. I'll just keep stepping up. Next one is Rio, who iron ore, copper we've been through, and they also aluminium. So you can see this basing pattern that's now breaking out along with other commodities. So Rio is already done its break from consolidation, so it'll just pioneer upwards. Another commodity is zinc. So that's mined along with aluminium by this guy, South 32. So he's got a lovely bull flag going on there, flagpole, flag break. Then we've got Evolution, so they're copper and gold mining. Then we've got Origin, so they're a bit of sell your electricity and a bit of gas production. So they look like they're back to a buy now. Then we've got Santos, oil and gas. Not my favourite play, but it's an ETF. Can't get rid of your cousins. Orica. So they're mining services, explosive business. Ramelius, so they're a gold miner. I'd say they'll be taking out their highs this week. Then we got Pilbara, lithium, just stepping on its way to make, I'd say, new highs. Linus, bit of a disappointment at the moment. Rare earths, that was the whole Trump-China thing. Anyway, hopefully it's making a bottom. Worley, so they're engineers in the mining business. Haven't been doing too well because they ventured into the green energy space. Anyway, enough of that. Ampol, so they buy and sell petrol, oil to petrol. Perseus, so gold miner. Then we've got a coal miner, so this is our coal price. So we've got Whitehaven Coal, so that's, again, there's your flag, your flagpole, there's your flag, looks bullish. Mineral Resources, so they're a bit of lithium, iron ore and mining services. They look good to go. Genesis, so another gold miner. Capricorn, another gold miner. Sandfire, so it's copper and gold. So we're going down the weightings now, and this is also where the ninjas come in, because there's like gold ninjas, copper ninjas, uranium ninjas. So you can beef up MVR to get to some more risky but high reward ETFs. Horizon, so they're rail freight. Dino Label, so they're explosive business. Regis, another gold miner. Liontown, lithium. Palladium, so they're uranium miner. Monadelphous, so they're mining services. Getting a little bit of a flag there. Aluka, so they're in the rare earthish business, mineral sands. IGO, so they're lithium and breaking out. Beach, so they're oil and gas. Got their new gas project coming online early next year. And the DRR, royalty, iron ore royalty business. Okay, so they're all the underlying holdings. So now it's how do you build the portfolio around your tank and your ninjas. Okay, putting the portfolio together by Rooster Productions. Okay, so how I see it is think of it, it's a war game. So the objective is to destroy the enemy who live in the castle, and they've got riches in the castle. So the first decision is what type of attack will I do? That basically depends on, do I want the riches in the castle? So basically if you say yes, you want the riches, then you're saying you want high growth. If you don't want the riches, just means you want income with a bit of growth above inflation. Okay. Alright, so you decided you want the riches. So the plan of attack, you're going to need a tank to destroy the castle, and then some ninjas to go and steal the riches. Okay. Alright, so the tank is MVR, so he just sits in the background there and drops his bombs, throws his missiles into the castle. So he doesn't get his hands dirty really, but he does good hard chunk of it. And then you're going to need some ninjas. So these ninjas do a dangerous job, obviously, because they're going into the castle. So there's two types of ninjas. There's ASX ninjas. So there's ETFs like XMET, which is a sort of, it's got a whole lot of copper, rare earths, lithium, silver miners in there. It's not bad. Uranium miners, your gold miners, your silver ETF, your copper miners, your small companies ETF, like a defense tech ETF, or any of your own growth ideas or shares that you might have. Then we've got some special US based ninjas. So these are which you can't get on the ASX. So these guys do a bit more of a powerful job than the ASX ones. So we've got a rare earth ETF, a uranium ETF, but these are the large caps. These are the medium cap uranium miners. SilJ, which is your silver miners. You get a little bit of them in XMET. GDXJ, which is your mid-tier gold producers. Miners is your senior gold producers. So in a bull market, the mediums outpace the seniors. So that's why I say they've got special growth powers. And LitP, which is a lithium ETF. You get a bit of lithium in there, but you get more depth. So in here, for example, in XMET, you might get one or two companies in lithium, whereas in here you get about 30. Okay, all right. So what percent of tank and ninjas should I use? All right. Well, so ultimate risk, like game on. I'll take anything. Alright, then you just go with no tank and just ninjas. Okay, you just go all in. So it can be done. I do have a subscriber who's done the just ninjas, and he in his first month he got a bit nervous because it dropped 10% in a week. Now he's laughing, but ninjas do a dangerous job. So if you're going to have ninja, you're going to expect, a week one of those ninjas could drop 10% in a week. Let's just set that. That's how dangerous the job is. But in a bull market, I expect them to come back like that sub did. He was in Remex, the rare earth one. Now he's up about 30 or 40%. Or you can go medium risk, okay? So that would be a 50-50 job, 50 tank, 50 ninjas. Or you can go low risk, but not low risk as in cash. But that would be just the tank. But I'm still, when you go the tank, I'm still expecting the tank to outperform VAS, VGS, IVV. So it's not, it's not low risk like in the bank. There's still volatility, but the tank isn't going to drop 10% in a week. Okay, so you've got to sort of work out your risk profile there. I don't want to be given personal advice around, what. The rooster, I'll get in trouble from the rooster. He's my compliance officer. All right, or you decided, okay, I don't want the riches. I've got enough money. I don't need to make 30-40% in a year. I'm just exaggerating, but these ninjas I expect to make at least 10-20% per annum. A lot of them are up all that in 6 months. But it's nothing's guaranteed. It's a dangerous job. You get reward for the risk you take. All right, so you're still going to need a tank to destroy the castle because you've got to do some work. But you're going to need some drinking buddies. just sit in the tank with you. So your drinking buddies are like your VHY, SYI, so dividend ETFs, ASX 300 div shares, or property trusts. Okay, so in this scenario, what percent of tank and drinking buddies? Well, I'm thinking, like, if you're on ultimate income, then you go like 30% tank, because the tank's going to pay you a 4% div. So you can put that in the bank. And then say 70% drinking buddies, who'll pay you, I don't know, 6%. So that you still got you could just have drinking buddies, but they'll drink too much and they won't do any work. So the tanks, the growth performance of the tank will outperform the drinking buddies. Okay, because the tank's going to outperform VAS, and VAS is sort of the banks and your drinking buddies. Okay, so all right, or you want a good income but a bit of extra growth. So you set the bench, say 50% tank and 50% drinking buddies. All right, so that's just a framework. And each weekend I go through, do a video on the dividend shares and ETFs, and I do a video on all the ninjas. Alright, hope you enjoyed that. Let us know your thoughts. See ya.